Right now, there are two silver markets operating simultaneously. One is the price you see on your screen, $84 an ounce. The other is the price that sovereign buyers, industrial giants, and central banks are actually paying behind closed doors. And those two numbers, they are not the same. Today, I'm going to show you exactly why that gap exists, what it means for where silver is heading, and most importantly, what the smart money is quietly doing about it, right now, in March 2026. Stay until the end, because the final piece of this puzzle is the one most people completely miss. Let's get into it. But real quick, before we break down the charts, if you want to stay ahead of these market shifts and get the actual data instead of just the headline hype, make sure to hit that subscribe button right now. Then I want to hear from you right out the gate. Are you buying physical silver right now, trading paper, or just watching from the sidelines? Drop a comment below and let me know what actually happened this week. So let's start with what's actually happening in the silver market right now, because this week has been a wild ride. And if you only looked at headlines, you probably missed the real story. Spot silver closed out the week sitting around $84 to $85 per ounce, up about 2.6% on the day. On paper, that sounds decent, right? But zoom out just slightly, and we're actually down nearly 9.5% on the week. That's a significant pullback from where we were. So what happened? Tuesday. That's when things got messy. Yields spiked, the dollar strengthened, and silver got hit hard. That sell-off was swift, it was violent, and it shook out a lot of the weak hands who had piled into silver on the rate cut narrative. Then Friday morning drops the February jobs report, and it's a disaster. The US economy shed 92,000 jobs. The expectation was a gain of 55,000 to 59,000. That is not a miss. That is a faceplant. Unemployment ticks up to 4.4%, and wage growth still running at 3.8% year over year. Now here's why that matters for silver specifically, and why it creates one of the most uncomfortable situations the Federal Reserve has been in for years. The Fed's impossible position, and why silver is caught in the middle. Think about what the Fed is staring at right now. On one side, a labor market that just fell off a cliff. Layoffs are real. Consumers are feeling it. On the other side, oil is back above $90 a barrel. WTI sitting at $90.90. Brent crude at $92.69. Middle East tensions are not going away, and energy prices feed directly into inflation. So do you cut rates to save the economy and risk reigniting inflation that you've been fighting for 2 years? Or do you hold, maybe even hike, and watch unemployment creep higher while people struggle? That, right there, is the textbook definition of stagflation, and it's the single biggest headwind silver is navigating right now. Here's the thing, though, and this is what I want you to hold on to. Stagflation is historically one of silver's best environments. Not immediately, not cleanly, but over time, when fiat purchasing power erodes and real assets revalue. Silver has been one of the biggest beneficiaries. We saw it in the 1970s, we saw echoes of it in 2011, and the conditions building right now rhyme louder than most people are willing to admit. The two-tier silver market nobody's talking about. Okay, here's where it gets genuinely interesting. While COMEX paper silver is trading in that $78 to $84 range, and that's the number your brokerage app shows you, physical silver premiums in certain international markets are telling a completely different story. We're talking premiums of 14% to 26% above spot in parts of Asia and the Middle East. Physical buyers aren't paying $84 an ounce. They're paying $95, $96, even pushing toward $100 in some markets. Why does that gap exist? 2 words: supply deficit. The Silver Institute is projecting the 6th consecutive year of market shortfall in 2026, 6 years in a row. The projected deficit this year? 67 million ounces, despite global supply potentially hitting a 10-year high. Let me say that again. Supply is near record levels, and we're still running a deficit, because demand is growing even faster. Solar panels, electric vehicles, AI infrastructure, consumer electronics. The industrial demand for silver is not slowing down. It's accelerating. And COMEX inventories, they're being drawn down. When physical inventory leaves the exchange and doesn't come back, that matters. That's not a paper game. That's real supply leaving the building. So when you see that paper price get smashed on a yield spike or a hawkish Fed comment, and you will see it again, the question to ask yourself is that a reflection of silver's fundamental value? Or is it a short-term financial market reaction that the physical market is already disagreeing with? We've seen this movie before. Now, I want to give you some historical context here, because understanding where we've been makes it a lot easier to read where we might be going. In the early 1970s, Nixon closed the gold window. The dollar was cut loose from its anchor. What followed was a decade of inflation, dollar debasement, and an absolutely explosive run in precious metals. Silver went from under $2 an ounce in 1971 to nearly $50 by January 1980. That's a 2,400% move in less than a decade, driven by a combination of monetary instability, inflation fears, and industrial demand. Now, I'm not here to tell you silver is going to $50 again, or $150, or whatever speculative number someone's putting out on social media this week. What I am telling you is that the macro conditions that drove those historic moves, dollar credibility questions, persistent inflation, supply constraints, those conditions are more present today than they've been in decades. The gold to silver ratio currently sits around 61 to 1. Historically, when that ratio has been this elevated, silver has often outperformed gold substantially in the recovery phase. In 1980 and again in 2011, those ratio reversals came with silver gains measured in hundreds of percent. That doesn't mean it happens tomorrow, but it does mean the setup is worth understanding. The catalysts that will move silver in the weeks ahead. So what should you actually be watching? Number 1, CPI and PPI data coming next week. If inflation comes in hotter than expected, that kills rate cut bets, boosts real yields, and pressures silver short term. If it comes in cool, that's the green light for a move back toward 88, maybe 90. Number 2, the Fed's tone. Right now, markets are pricing in maybe 50 basis points of cuts this year, spread across 2026. But that could shift fast. Watch for any Fed speakers walking back that guidance or doubling down on it. Number 3, oil. If crude holds above $90 and pushes toward $100, that's inflationary, and it makes the Fed's job harder. Energy is the wild card here that most silver traders aren't pricing in correctly. Number 4, COMEX inventory levels. I'll keep saying this. When registered inventory draws down and open interest stays elevated, that's a stress point. It doesn't always resolve dramatically, but when it does, it moves fast. And number 5, the physical premium spread. If you're seeing that gap between paper price and physical premiums widen further, that's your signal that the market is fracturing. When paper and physical disagree this loudly, eventually one of them blinks. Thinking through the bull versus bear case. I want to be straight with you here, because I think the worst thing I could do is give you a one-sided picture. The bull case for silver is real. Supply deficits are structural. Industrial demand is secular. Rate cuts, whenever they come, are a tailwind. And the macro backdrop for hard assets over the next several years looks more favorable than it has in a long time. But the bear case is also real. A stronger dollar crushes silver. If the Fed pivots hawkish, pauses cuts or even hikes, real yields rise, and non-yielding assets like silver feel it. And if we get a proper risk-off event, silver tends to sell off alongside equities before it recovers as a safe haven. The technicals right now have silver in a consolidation range, support near $80, resistance near $88 to $90. A decisive break either way tells you a lot about where the next leg goes. What I'd tell you is this. If you're looking at silver as a long-term position based on the structural thesis, Short-term volatility is the price of admission. If you're trading it tactically, respect those levels and respect your stops. And if you're doing neither of those things, if you're just curious about how these markets work, then hopefully today gave you a clearer picture of what's really driving that price on your screen. So, remember when I said at the very beginning? 2 silver markets. One price you see, one price being paid. That gap between paper prices and physical premiums isn't an anomaly. It's a signal. It's the market telling you that the two systems, the financial system and the physical supply chain, are starting to disagree. Whether that gap closes because paper prices rise to meet physical, or because demand falls and physical premiums compress back down, that's the question. And it's the question I'll be tracking closely in the weeks ahead. If you found this breakdown useful, hit the like button. It genuinely helps this channel reach people who are trying to understand these markets at a deeper level. Subscribe if you want the follow-up when next week's CPI data drops. I'll have a full breakdown up within 24 hours of the release. And drop your take in the comments. Where do you think silver is heading from here? I read every single one. This video is for educational and informational purposes only. Nothing here constitutes financial advice. Always do your own research and consult a licensed financial professional before making any investment decisions. Stay sharp. I'll see you in the next one.